Hello everyone, I'm Shannon Raw with Tax Analyst. Thank you for joining us today for the latest installment in our weekly discussions on tax reform. Now, this topic is particularly timely because just last week, Speaker of the House Paul Ryan gave a much publicized speech talking about the need to enact tax reform. And his timeline is the end of the year, which is a pretty ambitious goal considering that's only 6 months away. And there are still some unresolved differences between the House blueprint and where the administration currently stands. Now today we're going to focus on a singular aspect of this whole tax reform debate, and that is the challenges of reducing the corporate statutory rate. So that may be easier said than done, and to kind of talk us through that, because today I am joined with Scott Greenberg, who is a senior analyst at the Tax Foundation, and he recently wrote a paper on this very topic. So he is kind of the perfect person to walk us through this. So thank you for joining us today.
Thanks for having me, Shannon.
Absolutely. So to get started, I have a pretty easy question. So like I said, you recently wrote a paper on this, concluding that lawmakers need to think outside the box if they want to get the corporate rate cut to be deficit neutral. Now, you discussed the idea of repealing many tax expenditures currently in the tax code. So my question is, what exactly is a tax expenditure?
That's a great question. A tax expenditure is a provision of the federal tax code that looks in some way like a spending program.
Okay.
So to take an example, let's say that we wanted the federal government to subsidize low-income housing. Well, we could come up with a regular spending program that would be passed through appropriations, administered by Department of Housing, or we could create a new tax credit for providers of low-income housing.
Sure.
That tax credit wouldn't officially be a spending program. Technically, it would be reducing people's tax liability, reducing the amount of money they pay to the federal government, rather than spending the money that the federal government collects. But in practice, the two programs could operate very similarly as ways of giving money that the federal government would otherwise have to providers of low-income housing, which is why we call them tax expenditures, to signify that there are all these parts of the tax code that sort of operate in lieu of spending programs.
Okay, that makes sense. All right, thank you. So you actually identified 54 of these specific tax expenditures, and they run the gamut of economic activity. They include popular items like the R&D credit, the manufacturing deduction, but you didn't include the deferral of foreign profits or bonus depreciation. So some might suggest that there's a case for including those items as well. How did you determine what counts as a tax expenditure?
So that's also a great question. In fact, when you start with the full list of tax expenditures, there are over 150 of them.
That's a lot.
Yes. This is one of the reasons why the tax code is complicated.
Sure.
So for this particular exercise, I wanted to focus on just the ones that corporations claim.
Okay.
Because I thought it would be useful in context of the debate about how do we pay for a lower corporate rate. So that narrows down the list to about 80, but I didn't consider all 80 tax expenditures, and part of that is because there's a bit of controversy about exactly which tax code provisions count as tax expenditures and which ones don't. There are some provisions, you named bonus depreciation and deferral of foreign income. There are tax expenditures on the Treasury list, but in fact, you can make a case that they don't really operate like spending programs. Instead, they're sort of efforts to move the tax system closer to a different model, to a different paradigm. So in the case of bonus depreciation, there's sort of this eternal debate about whether we should be taxing companies based on their cash flow, which is how much cash they get, or based on their income, which is how much their net worth increases. Bonus depreciation is sort of a way of moving from an income tax to a cash flow tax. It's a half step. You could say, well, it operates sort of like a spending program. I think it operates more like a structural alteration to the business income tax. Same goes for deferral for foreign source income. It's another one of these compromise measures, in this case between a territorial system and a worldwide tax system. So if your baseline is that our US tax system is a worldwide income tax system,
And we're keeping it that way.
then deferral of foreign source income and bonus depreciation look like tax expenditures. But if you think there's sort of these compromise measures to change the basic structure of the code, you might not want to apply the label tax expenditure to them.
That makes sense. So in examining your list, it seems that not all of them were created equal, at least not in terms of cost to the Treasury. So some items were priced, in the few millions of dollars, like the credit for railroad maintenance. Others were priced well into the tens of billions, like the exemption for credit unions. The point is, these rules were pretty narrow in their scope, and it could be argued that they benefit relatively few taxpayers. If so, aren't we correct in questioning their policy justification? And don't all tax expenditures really create unnecessary distortions?
I think there's that's more or less true. Most of these tax expenditures have very limited policy justifications, in part because whenever you've got a provision that's aimed towards one particular industry or one particular activity, you have to ask yourself, how justified could this provision be?
Yeah.
If it's justified, why aren't we giving it to more people? And if it's unjustified, why are we giving it to these people?
Yeah.
That being said, there are a couple of these that have broad application that have some sort of rationale behind them. For instance, there's at least an argument to be made for the research credit. The idea being that whenever you as a company engage in research, there's benefits that you can't always capture. Your research helps society at large.
Absolutely.
So maybe we'd want to subsidize that as a federal government. Maybe we want to encourage activities that are socially beneficial but not necessarily beneficial to private actors. There are a couple other tax expenditures that can be justified in this or in similar ways.
Mm-hmm.
But of course then the rejoinder is, well, why put them in the tax code? Why not treat them as any other spending program? Why use them to make the tax filing process more complicated for businesses?
Absolutely.
And that's in many cases it's a product of historical circumstances or idiosyncratic features of the U.S. policy conversation.
All right, well, thank you. So in terms of overall growth effects on the national economy, which is the better outcome? What we currently have, which is a high rate, we have a 35% corporate statutory rate coupled with a multitude of tax expenditures. How many did you say, 150?
Over that, yeah.
Yeah, a lot. Which is exactly where we are now, or to have a much lower rate, to bring that down coupled with a more neutral tax base. What would you say?
So almost all economists would tell you that a broad base and a low rate is better than a narrow
lower the rate.
is better than a narrow base with a high rate. And the basic reason for this actually is that the harm of tax rates, the higher you bring a tax rate, the harm isn't just proportional. The economic harm is what mathematicians will call quadratic type of harm. Okay. That every time you double the tax rate, the economic harm will quadruple.
Oh.
Which is why a lot of economists are very focused on having the overall rates be as low as possible and having them apply to as many economic activities as possible. A world in which half of all the economy is subject to a 20% rate and half of it is subject to a 0% rate means that the 20% rate creates maybe 400 units of harm. Whereas an economy where everything is subject to a 10% rate, well, you've got double the parts of the economy subject to it, but the 10% rate is only creating like 100 units of harm.
Yeah.
So that's 400 compared to 200. That's sort of the basic intuition behind why most economists are very in favor of getting rid of targeted provisions that help out only certain sectors of the economy in favor of broad rate cuts that help all of the economy.
Makes sense. So let's move on to the major conclusion of your paper, which was you asked the hypothetical question, what if Congress repealed each one of these tax expenditures? How large a rate cut would that be? So could we get to the 15% that the White House proposed or the 20% that was proposed in the blueprint after carefully crunching those numbers? What was the answer?
After carefully crunching those numbers, we cannot get to a 15% corporate rate by eliminating tax expenditures for corporations, and we can't even get to 20 or 25%. What I found in this research is that if you eliminate every tax expenditure for corporations, that only raises enough revenue to lower the corporate tax rate to 28.5%.
Wow.
And I think this sort of bursts a bubble in a common narrative, which is, well, why can't we just get rid of all the loopholes and special preferences and use that money to lower our corporate rate? Well, if we do that, if we confine ourselves to sort of these normal tax expenditures, provisions that unambiguously look like spending programs, that's just not going to provide us enough revenue to lower the corporate rate by very much. 35% to 28.5%, that's a significant decrease,
Sure. Yeah.
but it's nothing compared to what folks on the Hill and in the administration are talking about. Which is why I concluded in my paper that really to get the corporate rate much lower than 28%, lawmakers are going to have to think outside the box in some way or another.
All right. So many people around the country would interpret that as a downer. I mean, that's not what we're really looking for there. So when we look back to the last major tax reform bill, the 1986 Act, we actually saw something completely different from this. We saw back then that Congress was able to lower the statutory rate from 46% to 34%. So that's a rate cut of 12 percentage points. That's huge. And if we could replicate those results today, we'd be looking at a new corporate rate in the low 20s. But you conclude those results are no longer possible. And what really explains that difference?
So it's interesting because there are actually more tax expenditures in the code now than there were in 1986.
Oh, wow.
And those tax expenditures are more expensive because a lot of them tend to grow over time.
Sure.
So actually I think there's sort of a broad myth that 1986 worked because it got rid of tax expenditures to lower the corporate rate. But in fact, 1986 actually did think outside the box. They tackled a lot of provisions in the corporate tax code that weren't technically tax expenditures, but that might have been narrowing the corporate base anyway. For instance, 1986 tackled the taxation of a lot of fringe benefits, benefits that businesses pay their employees that don't necessarily get counted in their employees' income.
Okay.
That was one of the big provisions that helped pay for a lower corporate rate in 1986. Crucially, in 1986, Congress also decided to muck around with depreciation schedules, and this was a big element of their approach. They took the existing accelerated cost recovery system, or ACRES, and they lengthened a lot of the asset lives and turned it into MACRES, the modified accelerated cost recovery system. And that allowed them to get some more revenue in the short term because when you've got longer depreciation schedules, fewer deductions for businesses, more taxes paid by businesses. But a lot of economists would argue that's not really a good trade, that trading longer depreciation lives in order to get a lower corporate rate is actually still a net negative for the economy because depreciation deductions are so important for determining what investments businesses are making. So some people are interested in pursuing the same strategy as 1986. We saw the Camp Draft Bill a couple of years ago, which did exactly that. The Camp Draft Bill eliminated a bunch of tax expenditures, but it also went after some provisions in the tax code that weren't tax expenditures, and it also lengthened asset lives. In many ways, it tried to follow the 1986 model, but there was a lot of pushback. So now lawmakers are looking at different models and exploring new concepts.
Non-starter.
Probably, yeah.
Okay, so what is the likelihood that business groups will look favorably on a tax bill that lowers the statutory rate from 35% to 28.5? Would that be satisfactory to proponents of tax reform, do you think?
So I think the answer is probably not. Number one, because I think a lot of proponents of tax reform are optimistic that we could get the business rate lower than that. And why settle for a half measure when you could go full on? Another consideration is international competitiveness. When you have a corporate rate of 28.5%, add in an average 4% tax rate on the state level, that's a combined corporate rate of 32.5%. That's still significantly higher than the average rate of 25% in the OECD among developed nations, and is even higher than the corporate rates of some of our major competitors.
Sure. The UK's under 20, Ireland's at 12.5.
Yeah. So I think that a lot of proponents of tax reform would rightly conclude that we can do better than just the simple trade-off of getting rid of all the corporate tax expenditures, lowering the rate to 28.5%. I think they would conclude that we can do better.
Yeah. All right, so what's the big takeaway here? In terms of the broader implications for enacting tax reform legislation before the end of the year, as Speaker Ryan has proposed, how can we get to a globally competitive corporate tax rate?
So I concluded in this paper that lawmakers will have to think outside the box. And I think they'll have to do that in one of three ways. If you remember our example, we only eliminated corporate tax expenditures. We made it a corporate-only reform. We made it a revenue-neutral reform where the tax expenditures were paying in full for the cost of cutting the corporate rate. And we made it a non-structural reform where we weren't touching structural parts of the tax code. And I think that if we want to get the corporate rate lower than 28.5%, we have to relax one of those three constraints. Maybe we make the bill not corporate only, so that we're using provisions from the individual income tax code to help pay for a lower corporate rate. And that can actually be, I think, a politically feasible proposition. Raising taxes on rich households in order to pay for lower taxes on all US businesses. That's an approach. Lawmakers could make it not revenue neutral, meaning just have a corporate tax rate cut that is partially paid for, but adds to the deficit a little bit. But that's a difficult proposition because of the rules that constrain Congress. If they're trying to pass a tax bill through reconciliation, it's got to be deficit neutral in the long run. Now, of course, they could cut spending programs to pay for a tax cut, but that's not always the most popular proposition either.
Probably not.
Or number three, they could move beyond tax expenditures and look at more structural parts of the tax code. How are we treating interest payments by businesses? How are we treating imports and exports? This is, I think, a lot of what Speaker Ryan has tried to do in his tax reform proposal, which is to rethink the basic structure of the tax code in order to move fundamentally to a tax concept that's a broader base that can support a sustainable lower rate in the long run. So I think any one of those three directions, not having a corporate rate cut be paid only by corporate provisions, not having it be revenue neutral, or expanding our scope into structural provisions of the tax code, any one of those strategies would help us get the corporate rate lower than 28.5%, but it'll take some real imagination and some real will from lawmakers in order to make that happen.
Wow, thank you. So final question. Do you have any predictions for what comes next, whether it's from Ways and Means or the Senate Finance Committee? What do you think?
To be honest with you, I have no idea. It's anybody's ball game right now. There are a lot of great tax ideas circulating among policymakers. Some of them are in the blueprint, some of them are from the camp draft. Some of them are things that we've heard from various senators over the past couple months. We'll just have to see what ends up in legislative text.
It'll be interesting. Well, thank you so much. I think we all learned a lot here, and we'll be looking forward to what happens.
Thanks so much, Shannon.